Owen back with us. Significant development for Spain, just as we await a defining decision from Germany. It's all about the debt crisis, this, isn't it?
I know we say this at least once a week, Stuart, but it is a big day in the Eurozone.
It's always a big day in the Eurozone.
An old cliche.
Yeah.
Absolutely right. We've got that Supreme Court decision in Germany just under an hour or so from now on its ruling on the legitimacy, certainly in terms of the German constitution, of the European bailout fund. But as you say, the Prime Minister in Spain, Mariano Rajoy, I think he pretty much woke up this morning deciding he may well like to tap that European Central Bank bond buying fund. He was talking to a couple of Finnish newspapers in Madrid and during those interviews told them that he is considering tapping that fund. Remember, unlimited funds available to countries like Spain and Italy to help bring down their borrowing costs thanks to the European Central Bank. But of course, this ruling from the German Supreme Court will be crucial to all that because it is all linked. If the German Supreme Court decides that Germany cannot sign up to this European Stability Fund, that will have serious implications for what the European Central Bank can do in terms of bringing down borrowing costs for countries like Spain. It will certainly make it more expensive, and of course it reduces the political legitimacy. There is so much politics tied up in all of this. It will reduce the political legitimacy for the ECB to start getting involved and basically buying up the debts and being a creditor to governments.
Well, we are, of course, awaiting a decision from Germany just under an hour from now. What about the markets? How are they feeling about it?
Well, looking quite steady at the moment, certainly as you'd expect. I think anybody that's invested in Europe right now is probably going to hang on and wait another hour or so to see what they want to do about Europe. You can see there steady, the FTSE down a little bit, the CAC 40 here in Paris about 0.2% up. The Asian markets had a much stronger day, much more China-focused in the last 24 hours. That was after some remarks from China's Prime Minister about the economy and meeting targets. Gave the Nikkei a lift, finishing the day at 1.7% up. Seoul as well in South Korea had a pretty good trade. Just Shanghai is looking a little bit flatter.
Well, one stock that did perform well on Wall Street yesterday was Facebook. Don't hear that very often, do you? It's in fact lost half its market value since its hugely hyped stock market debut in the spring, and it's triggered a bit of soul-searching from founder Mark Zuckerberg as he made clear during his first public remarks since Facebook itself went public.
Everything I do breaks, but we fix it quickly.
Fast moves like that helped Mark Zuckerberg build the world's largest social network with more than 950 million users, but Wall Street didn't buy into it. Since the company's disastrous initial public offering on the Nasdaq in May, Facebook has lost $50 billion in market value, and shares have been cut nearly in half. For the first time, Zuckerberg spoke about the Facebook flop.
Well, one of the big things, the performance of the stock has obviously been disappointing. And we're going to do the things that we think are going to build value over the long term.
He made Facebook's strategy going forward abundantly clear.
Mobile.
He mentioned the word 37 times in 25 minutes, but Zuckerberg dismissed speculation about a potential Facebook phone. Instead, the company will tailor its services and optimize ad revenue for mobile devices. The big problem? How to get advertisements on Facebook's mobile platform.
Over the next 3 to 5 years, I think the biggest question that is on everyone's minds is really going to be how well we do with mobile. Per amount of time that people spend on mobile, we think that we're going to make a lot more money than we do on desktop too.
Mobile may be the new direction, but it might not be the solution. Investors have questioned Facebook's platform before and will do so again. They're worried about the company's ability to generate new revenue apart from advertising, and prioritizing mobile might not allay these fears for long.
So a few candid words there from Mark Zuckerberg. Let's pick up on a few more of the day's business headlines for you now. The United States is facing another potential downgrade from another credit rating agency. Moody's is threatening to strip the world's biggest economy of its golden AAA rating amid concerns that Washington is heading for a fresh debt crisis. Standard & Poor's removed the US AAA last year during a government deadlock over reducing the budget deficit.
Russia has heightened tensions with the European Union over a long-standing gas dispute. President Vladimir Putin has decreed that companies considered important to national interest cannot talk to foreign authorities without permission. The move will complicate an EU inquiry into allegations that energy supplier Gazprom has exploited its dominance to disrupt European gas supplies.
And a former banker who blew the whistle against his former employer's Swiss bank UBS has been awarded the largest reward of its kind in the United States. Bradley Birkenfeld has been paid $104 million by tax inspectors. He helped them recover $5 billion from wealthy Americans who were dodging taxes by using secret accounts to hide their money. Birkenfeld was himself jailed for nearly 3 years for withholding other information from authorities.
Talking luxury for you now, because the luxury fashion brand Prada has dipped more than 2%, extending a similar slide 24 hours earlier. It was triggered, in fact, by rival Burberry issuing a profit warning, with the UK label losing a fifth of its market value. The sell-off is a shock. Luxury brands have actually outperformed during what are lean times for most. So why the panic? William Hildebrand investigates.
It appears a carefree stroll of Prada and other luxury brands could be coming to an end. Shares of the Italian fashion label Prada have dropped more than 8% since last week, a trend spreading around the world. British fashion house Burberry said profits would be on the low end of expectations. Its shares tumbled nearly 21%, amounting to a market value loss of £1 billion. Luxury brands sidestepped sluggish consumer spending in Europe and the United States by turning their attention to China and Hong Kong. The results have been impressive, but this sudden sell-off has triggered fears that China could be slowing down.
China now has the pressure of an economic downturn. One of the reasons is the world economy has not recovered from the 2008 financial crisis, especially Europe.
But Beijing is optimistic. The government says it's managed to steer the economy back on track.
China's economic development trend is good. Economic growth still remains within the target range set at the beginning of the year, and the economy is stabilizing.
That official target was 7.5%, but despite Beijing's best efforts, including a reserve €12 billion fund for further stabilization, analysts fear the economy could come up short. While European luxury brands were relying on the Chinese market, China in turn was counting on Europe as its largest export partner. Burberry had been the gold standard in weathering the economic climate, but even its coats might not be up to the task.
He's going to regret telling us this, but our producer Chris has just told us he's got some Prada underwear. We didn't see those in that report, thankfully. I'm sure on that tip, Stuart, I'm sure the two aren't related, but I wore my Mac for the first time to work in.
Did you?
6 months.
Got chilly, did you?
A little bit chilly. It's not a Burberry Mac, but yeah, I'm sure the two aren't related.
I don't think they are. Yeah, Prada knickers for Chris Bauer. That's his name, producer today. Owen, thank you very much. More from him tomorrow, and more from me tomorrow as well, because Claire Pride's got the latest after the break.